Hello and welcome to this new market dashboard for May 17th, 2025. A week that was much better for equities, obviously, as everyone noted. But there's a couple of things to note, though. I mean, the world doesn't revolve around equities only, and there's many more things to see. So we'll start with global major asset classes as usual. And of course, I always invite you to read the banner on top, just which are the necessary disclaimer for the regulator. But anyway, so let's start with the majors. S&P up more than 5%, the Nasdaq up more than 6% this week, so very positive week for the US equities. Things that are going on the right side with the US dollar stopping sliding at this time, the oil recovering slightly but not so much, Bitcoin rejoining the all-time highs. The other major news beside equities was the drop in gold, which is, obviously the balance between risk on and risk off. But the other positive thing that we can see here on all asset classes is that the activity measured specifically by short-term volatility ratio versus the longer-term volatility are down at this time, and to more normal, I would say, levels. So everything looks pretty fine at this time, or at least not as risk off and risk averse was. So we see some risk coming back on the market, some position coming back to the market. So you see the S&P 500 is up more than 20% of its lows. The VIX is being crushed as well, so everything about this points into the right direction. Similarly for gold, it's a kind of same story between risk off and risk on. However, the gold didn't collapse as much as the equity recovered, obviously, because there are, I believe, many factors playing into the price of gold at this time. Obviously, the one that we just discussed, which is a more risk-on environment globally, but also something that I mentioned in the Croissant Files newsletter, which is that the government spending is still very high. At least the trend at this time with the Trump administration is even higher. The government spending is even higher than what it was under Biden, which is an issue specifically about the debt issue, the printing probably that the Fed will have to do at some point if it continues. So there's a lot going on. So opposing factors that play at this time in the price of gold, and this is probably why in that kind of risk-on environment that we are getting back in at this time, investors are assessing their position on gold and, let's say, would reassess what they will do for the future, which will be determined pretty soon, because we'll talk about this right now, by the way. Because again, I mean, global picture on equities around the world, all the equities are up, which is obvious considering that we are getting trade deals which will support global world economy and activity. So it's a good sign of, again, VIX being crushed. You see that the activity ratios are going down significantly for every single equity asset at this time. Again, another positive. The less positive at this time is bonds, which is to be related to gold, by the way, because bonds are going down. We are going back to levels where the government panicked a couple of weeks ago, specifically because the government will not be able to finance its debt as easier as it would expect. You know that there are trillions to roll before August for the US debt. Of course, the US government wants to roll that debt forward with the lowest interest rate. This is not where it's going at this time. So since it was kind of the moment the government panicked a couple of weeks ago, we can wonder what kind of game the government will play now, because whatever the narrative is in the market, whether it's trade tariff, with us going up, tariffs going down, bonds basically refuse to go up, and so an interest rate going down, and only go down, meaning interest rate going up at this time. So this is a situation that the government will have to address. And specifically in that context, you see that the US 5-year CDS, which is the bottom chart, has risen quite significantly, not only since the beginning of the tariff, the trade war, but even the week after, and has not receded with equity markets going back up to a kind of situation of, let's say, normalcy. So this is again still to monitor, because the bond market will probably be the market to monitor going forward. So again, there are similar story everywhere. The US dollar has stopped its collapse, flattened for the week. All other major currencies going down against the US dollar, when year to date they were up significantly, and the US dollar being down. Volatility ratios, again, activity ratios going down. On the crypto side, it's kind of, well, I would say a little bit different, but not exactly comparable. You see that I think the major information that we can draw from this is that Bitcoin is back to its all-time highs. We're only about 1% away from the all-time highs at this point, when actually the Ethereum, Solana, Cardano, and even Ripple, that has performed pretty well over the last, since the beginning of the year, and even over the last year, it grew about 150%. All of them are below a 20% drawdown. So there's Bitcoin and there's the rest at this point. When I hear this, when I see this, I always think about that movie. Which one is this? The Highlander. There can only be one, and it's for the moment it seems to be Bitcoin, at least in the crypto space. So Bitcoin again, back to the top. The velocity, the money velocity, which is kind of taken as a advanced leading indicator for the price of Bitcoin, is rising up. So many are implying that the price of Bitcoin will rise as well, in conjunction with the money velocity rising as well. We'll see, but that's kind of the relationship that we've seen in the past. Yes, I wanted to look at the activity on the markets globally, and you can see here that the global activity has gone back to normal, let's say regular level, seen in most much quieter situations on the market. You can see on the top, well, you can see maybe not so much, but that the equity activity has dropped very significantly, as well as for the US dollar, as well as for bonds, except gold actually at this time, which is again the one that is still struggling to figure out where it's going in the near future. So activity is going down, again in conjunction with the more risk on environment. And what we see here is this is a chart that I don't share very often. And this chart is the risk-adjusted 1 year, I'd say, multi-time frame 1 year momentum. What do I mean by that? It's simply 1 year, multi-time frame 1 year momentum is a momentum calculated based on 1 month, 3 months, 6 months, and 1 year, divided by the volatility. It kind of gives you a rough estimate of what trend followers would be doing at this point. So what we see is that the risk-adjusted momentum has become positive again, in par with gold and Bitcoin. But oil is still down. We still have bonds with a negative risk-adjusted momentum, and the US dollar with a negative risk-adjusted momentum. The reason why the US dollar is the lowest risk-adjusted momentum is that the risk or volatility on currencies is much lower than in any asset classes, which increases which reduces, depending on which way you want to see this, the negative momentum for the US dollar. But what it indicates is that probably it will generate, specifically for trend followers, for trend followers, you have to have something happening and the momentum turning positive for them to follow, hence the definition trend following, and get back into the market. And this probably fuels some more money coming into the equity markets from these investors, but they are by far not the biggest part of the industry, so it plays a factor but not a major factor anyway. So yes, just for you to see a little bit better where this risk-adjusted momentum are, we see the S&P turning slightly positive, bonds and US dollar and oil being down, when the two other ones are gold, which is the risk-averse one. So you have a little bit of risk on asset with positive momentum, the one that has risk of momentum with a positive momentum as well, and you have the guy that is doing his thing, Bitcoin, which is positive as well at this time. Okay, so where do we go next? Similar story everywhere you look at, actually, because if you look at spreads here, equity markets versus the S&P, you see that the Nasdaq is overperforming the S&P 500, which is normal in a risk-on environment. The large caps measured by the Dow Jones index are going down compared to the S&P 500. Again, it's normal, reallocate. It's more risk off, obviously, large caps position, and so a transition from large caps to growth makes sense. The ones that are totally left out are small caps at this point. Nobody will care, actually. Similar story with defensive sectors, whether you look at utilities, consumer staples, or even healthcare. Both are, when they were performing pretty well in the risk-off environment, with the risk-on environment coming back, they are going down. So again, a confirmation that everything at this time is going into the same direction. Even the trend that we've seen since the beginning of the year, which was seeing money leaving the US to go to foreign markets, specifically European markets. This trend seems to be broken at this time. So we see money coming back in the US, which was actually confirmed by a report this week by Goldman Sachs, I believe. When I say that, if you know how to look, the market tells you everything you need to know, that's exactly what I mean. You don't need to wait for a report or having the chance of seeing the report that you should see. If you look at the market is telling you everything you need to know. And this is again another situation where we can see that money is coming back to US equities. Again, another sign of the improving situation on the equity markets. Very similar situation when we look at major assets versus gold. We see that, before a couple of weeks ago, all of these asset classes were smashed against gold in a massive risk-off environment. The bleeding has stopped, and it's coming back. So again, all good signs. S&P activity is going down, to normalcy. Again, I would say whether you look at it from a volatility perspective or even from a volume perspective, both activity metrics are going down to what, to their long-term average, I would say. Even if you look at the average pairwise correlation, then you can see that when it was going positive, in which is again a sign of risk off environment, that that indicator basically went down to negative, which sees more decorrelation between assets in a market, which is again a positive sign. So while everything seems to be going into the same positive direction, specifically for equities, because this is what people are looking at, when I believe they should be looking at everything else to figure out what will be happening on equities. Nothing is totally positive. You would expect that with the trade war easing situation and then more global trade and global activity picking up, you would think that oil would be picking up as well and not look as ugly as it's been over the last actually couple of years. Well, it had an impact, but didn't have any major impact on the oil market at this time. So some mentioned that could be the result of an expected deal with Iran about their nuclear program. I don't believe so, because we've seen over the past that not only countries find, oil is found everywhere now in the world. There's no shortage of oil anywhere in the world at this time. There is as much oil as you can find, and on the other side, the trade negotiations with China is only a pause for 90 days. It's not a deal yet. There's nothing achieved at this time. So the market going up is only based on sentiment and not real actual negotiations results. So probably this needs to be confirmed over the coming weeks between the negotiations with the US and China. Again, maybe last thing to be cautious about, the thing that I mentioned when I talk about bonds, which is here is TLT, so long-term bonds between 20 and 30 years. You can see that we around the max drawdown since 2015, and again we are next to the point where the government kind of panicked a couple of weeks ago. So again, this will be to be monitored if the bonds and interest rate would be still going up over the next days or even weeks. So that being said, the equity markets are up more than 20% from their lows. We are close to the all-time highs in equities. I believe that in the dashboard that I've shown you before at the very beginning, we are maybe 2 or 3% away from the highest high in the S&P 500. And so I wanted to share this with you. So who is this guy? This is not Michael Burry. This is the actor who played Michael Burry in The Big Short. And the reason why I show you this is because Michael Burry has sold, I believe, 98% of his portfolio at this time. He sold 98% of his portfolio, which I don't know if he's betting on the collapse of the market. He has been betting on the collapse of the market before. It worked well for him in 2008. It didn't work for him very well recently when he was betting against Bitcoin, and after a couple of weeks he said, okay, I was wrong about that. Is this the right call this time? Obviously nobody knows, but that will be interesting to monitor. The least I believe we can say is that after a recovery of more than 20% in only a couple of weeks, that is only based again on sentiment and not actual result of negotiations about the trade war with China, the least that we can expect is a pause at this time. And I believe that if the market to go up, we would need actual results of negotiations for the long term, because what the market asks is not really, tariffs, not tariffs. I mean, obviously there's a play at this in terms of the cost that companies experience to produce their results, and I talk about this in the Croissant Files newsletter. But the thing is that I lost what I was supposed to say. Anyways, sorry about that. Yes, the thing that I was mentioning is that we are due for a pause, and real news about the negotiation between the US and China that would be able to push the market up to new highs. Again, the recovery was fast, strong. We can expect a pause. That would not be totally surprising at this time. And again, we have diverging indicators on the market, whether it's gold, between risk off and risk on environment. Risk on, recovery with equities, trade war is going better, and risk off, which is the US debt increasing, the oil refusing to picking up at this time. I explained why, and the interest rates in the US, that could be a very significant problem for the markets over the next week. So I won't make it any longer than it's supposed to be, than it needs to be actually. I wish you a great weekend, and see you in the next video for the Quantaraxia market dashboard next week. Enjoy your weekend. Bye bye.